Canada is heading into one of the biggest waves of mortgage renewals in years. And the financial environment today looks very different than it did just a few years ago. During COVID, interest rates were at historic lows, and many Canadians were encouraged to take advantage of cheap borrowing, with Prime Minister Justin Trudeau publicly pointing out how low mortgage rates had become. Now, many of those same mortgages are coming up for renewal in a very different economic environment. Fast forward to today, and the economic environment has changed significantly. Inflation has become a major issue over the past few years, and global factors like energy prices can influence where interest rates move next. Recently, oil has moved back toward the $100 a barrel range, and when energy prices rise, it can push inflation higher. When inflation rises, bond markets often react, and that can influence fixed mortgage rates. That matters right now because millions of Canadian homeowners are approaching mortgage renewal over the next few years. Many of them originally secured rates under 2%, and now they are facing a very different rate environment when they renew. As a result, homeowners are trying to make some important decisions. One of the biggest questions people are asking right now is whether they should choose a fixed mortgage or a variable mortgage when they renew. The right decision depends on each person's financial situation and their tolerance for interest rate risk. Another issue we're seeing right now is parents and family members co-signing mortgages to help younger buyers get into the housing market. Co-signing can help someone qualify for financing, but it also means you are legally responsible for that loan if the borrower cannot make the payments. With high interest rates and higher costs of living, it's important for people to understand the risk before agreeing to co-sign. Some homeowners are also looking at the equity in their homes and considering second mortgages or home equity lines of credit. Accessing home equity can provide financial flexibility, but borrowing against your property also increases your financial exposure. With borrowing costs higher today than they were just a few years ago, it's important to carefully review the numbers and understand long-term impact. Another conversation happening right now involves renovations. Many homeowners assume that if they invest a large amount of money upgrading a condo or home, they will automatically get that money back when they sell. But when markets adjust or slow down, that isn't always guaranteed. Before investing heavily in renovations, it's important to understand the value of your property and what buyers in your building or neighborhood are actually willing to pay. All of this really comes down to understanding the full financial picture before making major housing decisions. Interest rates, inflation, mortgage renewals, and home values are all connected. And homeowners who stay informed are in a much stronger position when it comes to protecting their investment. If you're thinking about renewing your mortgage this year, thinking about using home equity, or planning renovations and want to understand how these changes could affect your property value and finances, feel free to reach out. You can comment below, send me a message, or call directly. I can also connect you with a mortgage broker I trust so you can review your options and make the best decision for your situation. I'm Debbie Evans with eXp Realty on the North.